Today is Tuesday, May 13th, and this is ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, Mark Bowman, ADMIS Senior Market Research Analyst, and a warm welcome to JP Steiner, ADMIS Associate Economist. Starting with the grain markets this morning, Mark, what were your biggest takeaways from yesterday's USDA reports?
Well, a couple of things jump out. First off would be the continued weak price action in the corn market, that despite the fact that the USDA came out with ending stocks below expectations for both old and new crop. It was no surprise USDA came out with record production here in 2025, given the big acreage number we got in March. However, the strong usage figures resulted in ending stocks coming in at 1.8 billion bushels, and that was at the very low end of expectations. The average guess was over 2 billion bushels, yet despite that, the prices continued to work lower here. July's hit a 7-month low this morning. I think it just illustrates how difficult it is to rally prices this time of year when U.S. weather is favorable. The crop is going in at a rapid pace. The drought conditions in the U.S. have eased, and history has shown that with the crop going in, that only increases the odds of reaching or exceeding trendline yields. Over time, that strong demand is going to have to prove itself. For now, the market seems to be a little bit skeptical with the USDA usage numbers. On the soybean side, also much tighter than expected stocks, especially given where everyone thought we'd be when the year began. We just really have very little wiggle room if we do not see trendline yields achieved with this year's production here in the U.S. So I look for beans, particularly new crop, to outperform corn here in an attempt to maybe swing a few more acres back into soybeans this spring. Bean acres have slipped from the March to that June, from the March intentions to the June report each of the last 4 years. The other thing jumped out, USDA just seems very optimistic with the winter wheat production and yields. They're both coming in at a 9-year high.
Mark, when will feed grain prices find a bottom? Or can you tell?
Yeah, that's a good question. I think Mother Nature will have a big say as to when exactly that's going to happen. But right now, from a drought perspective, the plain states are the area that seem to be most impacted. And these areas are forecast to get a couple of healthy rounds of rain here over the next 7 days. So bringing some short-term relief. But it's still a long growing season, particularly for corn and beans, which is just going in the ground. And a lot can happen between now and harvest. But wheat is showing some signs of wanting to bounce here today. We'd had new fresh contract lows across the board. Speculative traders, they're holding a record short position in Kansas City. July KC, that came within a quarter cent of that $5 price tag this morning. So from a contrarian perspective, I think you can buy wheat here, put a stop into new lows, and continue to work that stop up if the markets rebound here a little bit. So we've seemed to shrug off the couple of bullish things that could be out there. One, in East China, east central parts of China, a lot of their major wheat producing areas have not had a lot of rain here over the last several months. So, and the USDA has forecast them to import a lot more wheat here than they have in the last couple of years. So that's one area that I think that's well overdue for a bounce here is the wheat.
Thank you. JP, Treasury Department remains in the news. Fed Chair Powell's out there getting some headlines. What is the Fed's path to future rate cuts?
So the Fed is facing a delicate balancing act as it navigates its way through tariff headlines and economic data, weighing inflationary risks against signs of an economic slowdown. At its recent meeting, the bank held rates steady, reiterating a wait-and-see approach to monetary policy, highlighting increased downside risk to the economy, which could negatively impact employment and inflation. Unlike past cycles, policymakers are unlikely to preemptively cut rates based on forecasts alone. They're going to need to see concrete evidence, particularly in the labor market, before taking any action. This has set up what some describe as a goalkeeper's dilemma, choosing to maintain higher rates to combat inflation or lower them to cushion weakening growth. However, waiting for economic weakness to materialize means accepting the risk of a potential recession. The Fed decided to hold rates steady at its recent meeting in an effort to tackle inflation, as the labor market has remained strong in recent months. Last week, initial jobless claims were lower than expected, and the unemployment rate has held steady around 4.2%. Given these dynamics, assuming labor market strength holds, Rate cuts from the Fed will ultimately depend on weakening inflation data, which is likely to come under pressure as a result of U.S. tariffs. April's annual inflation cooled to 2.3%, the lowest since February 2021, while month-over-month inflation rose just 0.2%, which was lower than or in line with most economist expectations. The data is not a total surprise, as the effects of tariffs on prices most likely have not came in for the April prices, as companies rushed to get imports in before the duties were set. May and June will likely be when inflation pressures from tariffs become more evident in the economy. The increase in pressure on prices as a result of tariffs complicates the Fed's path to monetary easing. If tariffs result in the increase in inflation that many economists and consumers are predicting, then the Fed will keep rates steady until there is clear evidence of labor market deterioration, in which case the Fed will cut rates to stimulate the economy.
Thanks, JP. And looking at the gold market for a minute, what factors are limiting gold's upside?
There are several factors limiting gold's upside, from an increase in risk sentiment around the globe as a result of positive trade news, dollar strength, and elevated interest rates in the U.S. The reciprocal tariffs by the U.S. caused a surge in safe haven demand, resulting in gold prices reaching all-time highs as investors flocked to the precious metal during the uncertainty as markets tanked. In recent days, trade deals have been struck with the UK and China, with several more deals reportedly in the works. Now that markets have rebounded and sentiment has broadly increased, the waning safe haven demand has resulted in gold prices coming down. More positive news on the trade front will weigh on gold prices, as it is likely to elevate a risk-on sentiment and strengthen the dollar. On the topic of the dollar, recent dollar strength has weighed on gold's upside, as the two assets tend to move inversely. The dollar index, which is coming off more than a two-year low, reached late April. Its rebound, which has been spurred by a renewed faith in the U.S. economy following positive trade developments, has created strong headwinds for gains in the precious metals. April CPI report was bearish for the dollar, which has slipped a bit since the report came out, but uncertainty surrounding future inflationary pressures may lead to higher inflation readings in the future, holding dollar strength. Continued strengthening in the dollar will depend on these future inflation readings and positive trade news from the U.S. Elevated interest rates are also a limiting factor of gold's near-term upside, however, not a major factor, as gold has made historic advances despite strong interest rates in the U.S. and around the globe. This being said, a reprieve in interest rate conditions in the U.S. would be supportive of gold, which tends to benefit in a lower interest rate environment. Now, despite the various factors limiting near-term strength in gold, gold-backed ETFs have remained supportive of the yellow metal, driving strong demand from around the globe. Demand for gold-backed ETFs have resulted in inflows of over 115 tons of gold for the month of April, which was the highest inflow since March 2022. May saw an inflow of just under 92 tons, and February saw inflows of over 100 tons. Combined with strong central bank purchasing of gold, the long-term outlook for gold is still robust despite near-term headwinds.
Thanks, JP. Mark Bowman, what did today's Unica report tell us about Brazil's sugar production for 2025-26?
Okay, so this was the second report. These come out every half month, and so this covered the second half of April. The first half of April report were a bit headed last year, and that did pressure the market. And today's report, though, came in well behind last year. This is kind of expected. They had a little more rainfall in Brazil during the second half of April, which would have slowed harvest, slowed the crushing process. Still in all, we had crush at 17.7 million tons, which is down from almost 35 million a year ago, so half. And cumulative crush now 34.2 million versus 51.1 million a year ago, 33% behind. Likewise, sugar production, 856,000 tons during the second half of April versus 1.8 million this time a year ago, so less than half. And cumulative production now 1.58 million tons versus 2.58 million a year ago. Ethanol production also behind, down only 985 million liters versus 1.5 million a year ago. So the question is now, is this lower production a reflection of just the weather conditions in the second half of April, or is this an indicator of what production is going to be for the whole season? We had a very dry year last year. They had historic drought. They had wildfires in many of the cane fields last fall, and which probably set back cane production quite a bit.
And lastly, Mark, how is the U.S. cotton crop shaping up?
So we had a crop progress report yesterday. Still, we're starting to slip behind the average pace. We started out a little behind, then caught up. Now we're behind again. 28% of the crop planted versus 32% a year ago, and a 5-year average of 31% for that date. Likewise, Texas, 27% planted versus a 5-year average of 29%. We actually had gone ahead of average a couple weeks ago when they got some good rains. They still need more rains to recharge the soils. Georgia, a little bit behind, 24% versus 28% on average, but Mississippi is way behind. They're only 25% versus 39% on average, and that is due to primarily to too much rain in the Delta. They've had flooded fields in some cases, and so they need some drying out. Doesn't look like they're going to have that though in the next week or so. The supply demand report yesterday from USDA did show ending stocks lower than expected. Cotton production, 14.5 million bales versus up slightly from 14.41 million last year. This is despite lower plantings. USDA is assuming an average abandonment rate and yield. Exports are nudged higher, 12.5 versus 11 million last year. And this put ending stocks at 5.2 million versus 4.8 million last year. But the stocks usage ratio, 36.6% versus 37.5% last year. The 5-year average is 28%. So like last year, we're running a bit loose on stocks. So this cotton needs a strong demand outlook, and that is, of course, uncertain. Brazilian production, Brazil's taken over from the U.S. as the leading exporter the last few years. Their production looking at 18.25 million bales versus 17 million last year.
Thank you. Thank you all. Remember, the views and opinions expressed today in this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.